In 1929, the world learned how fast prosperity can turn into panic. One morning, investors believed they were living in a golden age. By evening, that confidence had turned to dust. Markets crumbled, fortunes vanished, banks went silent. People who thought they understood wealth realized they were standing on sand. Most assume it was a one-time tragedy, but history never closes a chapter cleanly. It leaves echoes, and those echoes are visible today. Ask yourself, why do prices rise faster than paychecks? Why does housing feel unreachable? Why does debt grow while opportunity shrinks? What you see isn't random. It's the unfinished story of a system built on confidence and what happens when that confidence cracks. Before we start, subscribe and like, because the real story of 1929 isn't in the fall, it's in the climb. The late 1920s felt invincible. Newspapers called it a new era, a future where the old rules no longer mattered. Everyone wanted in. Farmers, teachers, shopkeepers, ordinary people who had never touched the stock market were suddenly obsessed with it. Why? Because the market only seemed to move in one direction, up. Stocks soared to record highs. Technology was booming. Credit was cheap. Companies bragged about innovation. Politicians promised endless prosperity. Sound familiar? People borrowed money just to buy more shares. They were convinced the good times would stretch forever. Even those who sensed danger felt pressure to join the frenzy. No one wanted to be left behind. After all, how could anything go wrong when everyone was making money? But beneath the optimism, something fragile was forming. A structure built not on productivity or real growth, but on borrowed money and blind faith. And that combination has never ended well in any era. Because every time society believes it has outsmarted risk finds a way to remind us it still exists. Before 1929, debt grew faster than income. People purchased homes, cars, radios, and appliances with money they didn't actually have. They weren't reckless, they were optimistic. Advertisements told them the future would be richer. Banks assured them loans were safe. Politicians said prosperity was permanent. But ask yourself, what happens when an entire economy lives on money it hasn't earned yet? By the fall of 1929, debt had become a national lifestyle. The economy was booming on credit, not on strength. Fast forward to today. Global debt has exploded to more than 300% of world GDP. Governments, corporations, individuals, everyone is borrowing. We call it growth, but it's really a trade with the future, a hope that tomorrow's prosperity will pay for today's lifestyle. The pattern is identical. The scale is vastly larger. Back then, banks sold risky loans disguised as opportunity. Today, those loans hide behind complex financial products with impressive names. The packaging changed. The psychology didn't. People still chase comfort with borrowed confidence. And confidence is fragile. All it takes is one crack. Most people don't realize this, but modern economies don't run on money. They run on belief. Belief that the system works. Belief that banks are safe. Belief that tomorrow will be better than today. In 1929, belief evaporated instantly. Investors saw a few stocks falling and rushed to sell. The selling triggered panic. Panic triggered collapse. And collapse revealed the truth no one wanted to face. The prosperity of the 1920s wasn't real wealth. It was confidence disguised as stability. Today is no different. We trust central banks to fix markets. We trust governments to manage debt. We trust technology to boost growth. But what happens if that trust fades? What happens when people stop believing? Because confidence is the real currency of the global economy. When people have it, they borrow, spend, and invest. When they lose it, economies freeze. And we've seen this freeze before. In 2008, in 2020, in 2023 with sudden bank failures. Confidence cracks quickly. Rebuilding it takes years. And the unsettling truth is that once trust begins to slip, it rarely returns to where it was. Doubt spreads quietly, reshaping behavior long before headlines notice. That's why even small shocks today feel bigger. They strike at the belief that holds everything together. During the Roaring '20s, wealth pooled at the top. A small elite controlled the majority of capital. Meanwhile, the working class relied on loans and hope. They felt richer because they had access to credit,
but their real wages stagnated. Then the crash came. The elite survived. Everyone else didn't. Today, inequality is even more extreme. The top 1% owns more wealth than the bottom 90% combined. Asset prices inflate, making the wealthy richer. Wages barely move, leaving the rest dependent on credit. It's the same structure, only bigger and more dangerous. Because extreme inequality doesn't just strain finances, it strains society. It fuels frustration, distrust, and political division. History shows what happens when those forces collide. The 1930s taught us how economic pain can reshape politics. We're watching similar tensions rise again. And the worrying part is how familiar it all feels. Rising anger, shrinking opportunity, and a growing sense that the system rewards a few while leaving everyone else behind. When people lose faith in fairness, they don't just blame the economy. They question the entire order around them.
One of the biggest mistakes before 1929 was believing speculation was the same as growth. People invested in companies they didn't understand, convinced that rising prices meant rising value. When you borrow 90% of the price of a stock, even a small decline wipes you out. That's what happened. Margin calls, forced selling, domino-style collapse. Today, the speculation is digital. Meme stocks ignite overnight. Cryptocurrencies swing wildly. NFTs appear and vanish. Social media influencers replace financial advisors. Crowds chase profits they don't understand. The psychology is identical. FOMO, greed, the illusion of easy money. And the same belief returns again. This time is different. It never is. Because whenever people chase wealth without understanding risk, the result is always the same. Confidence outpaces reality, and reality eventually catches up. The tools may look modern, the charts may glow on screens instead of tickers, but the human impulse hasn't changed. Easy wealth feels tempting right until the moment it evaporates. Here's one difference between 1929 and today. It's also the most dangerous. In the 1920s, the financial system was national. When it collapsed, it destroyed millions of lives, but it was mostly contained within borders. Today, every economy is intertwined. A shock in one country can trigger tremors across others in seconds. We saw it when the Silicon Valley Bank fell. We saw it when China's real estate giants collapsed. We saw it when currencies tumbled after policy mistakes. Capital moves faster than regulation. Markets move faster than comprehension. Algorithms buy and sell without emotion, turning tiny shocks into tidal waves. When a crisis begins today, it doesn't unfold over weeks like in 1929. It unfolds in hours. And in a world with $300 trillion in global debt, even a small miscalculation can become catastrophic. What once took months to break now fractures instantly, amplified by technology and global exposure. And the unsettling part is that most people don't see the chain reactions forming beneath the surface until they're already in motion. In a connected world, distance offers no protection. Everyone is tied to the same financial heartbeat. What made 1929 so destructive wasn't only leverage or debt, it was the mindset. The belief in endless growth became a kind of religion. Anyone who warned of danger was dismissed as negative or old-fashioned. Sound familiar? Before every collapse, people feel safest. They trust the system. They celebrate innovation. They mock caution. They think technology, policy, or new models have made risk obsolete. Then something breaks. A default, a liquidity freeze, a policy error, and the illusion evaporates. Today's markets rely on confidence more than fundamentals. That makes the system not stronger, but more fragile, because when belief sustains an economy, disbelief can destroy it. Before the Depression, warnings were ignored. In 2025, warnings are ignored again. The question is, are we any wiser? Or just better at denial? The danger now is how quickly sentiment can flip, how fast optimism can collapse into fear with a single shock. And when faith in the system shifts, it doesn't drift slowly, it snaps, taking stability with it. After the crash, governments introduced reforms, deposit insurance, financial regulations, social safety nets. These measures didn't end the Depression, but they prevented total collapse. They also taught leaders one lesson: deflation is deadly. To avoid deflation, modern governments embraced inflation instead. They stimulated economies with spending. They printed money during crises. They accepted rising prices as the price of stability. But printing money creates its own risks. Inflation quietly punishes savers. It rewards borrowers. It shifts wealth upward. It distorts markets. And once governments learn they can fix crises with money creation, they rely on it permanently. What was once an emergency tool becomes normal policy. That's how systems drift. That's how risk becomes routine. That's how illusions become foundations. Today's economy floats on debt that will never be repaid, on confidence that can't be measured, on growth that depends on credit, not productivity. If that sounds familiar, it should, because it's the same logic that built the 1920s, just scaled to the entire world. Take a look at your own life, your prices, your opportunities, your savings, your debt. Ask yourself, does this feel sustainable? Does this feel stable? Does this feel safe? The ghost of 1929 isn't hiding in textbooks, it's standing in plain sight. In inflated markets, in historic inequality, in rising debt, in fragile confidence, in the belief that this time is different. The real danger isn't that history repeats. The real danger is that we're repeating history without realizing it. Crashes don't explode out of nowhere. They grow slowly, inside belief, inside the quiet assumptions we stop questioning. So the question becomes, when the illusion breaks again, and it will we recognize the moment? Or will we be like those in 1929, watching the future collapse while convinced the past could never return? Because the signs aren't subtle anymore. They're blinking in data, in headlines, in daily life. If this made you think differently about today's economy, share your thoughts below. Are we wiser now? Or just walking the same path, only in better suits, with better technology and the same old blind spots? History isn't over. It's repeating in slow motion. And this time, the world is watching, even if most people still refuse to see. Subscribe now. The next videos will reveal the hidden empires and secrets of money that history tried to erase.